You spent the last 8 years building this company. After cash crunches, 80-hour work weeks, and endless late nights, you hit $20 million in revenue. Now you're here, at the peak. It's time to sell. Growth is plateauing, and you're ready to cash out, and so are your investors. This is exactly where private equity loves to show up. So you engage an investment bank. They'll be taking a cut, by the way. Note, these are just example logos. You put together an investor memo and data room, kick off the roadshow, and do your best Steve Jobs impression. Fast forward a few months, and you have your best offer. 4x revenue, $80 million for your company. After merely a decade of grinding, this sounds like your ticket. Times for some mental math. After raising a few rounds of VC funding, you've got a 15% stake in the company. First, your investment banker takes their cut of the payout. That leaves $78 million to divvy up. That equates to a $12 million payout for you. But wait, unless you like federal prison, you gotta pay your taxes. And since you're a millionaire, Uncle Sam's gonna be taking about half. Still a healthy $7 million payout. Now, if you're like most startups and have a co-founder, you probably have less equity, but let's assume you don't. You signed the papers. You're finally rich. You're dreaming of paying off your mortgage, buying that Lambo, maybe a yacht. Hold your horses, son. Remember when I said that PE firm offered you $80 million? That's not quite how it went down. You see, you wanted $80 million, but the PE firm only wanted to pay it $60. So your investment banker had a brilliant idea, something that's called an earnout period. Now, 1/3 of your compensation depends on you growing the company 20% for the next 2 years. And the agreement you signed has a 24-month transition period where you still have to work for the PE firm while the rest of your payout vests. But at least they're paying you after all, right? Right? Actually, not quite. Technically, your company is the one paying you. The PE guys told their buddies at the bank to write a $100 million loan to your company. That pays you and your investors, the PE firm takes ownership, and your company is on the hook for the loan. And technically, this is done by merging everything into a new co. This was called an LBO, or a leveraged buyout. But why do this? You see, before the acquisition, your company made $20 million in annual revenue, about $4 million in net income, and paid $1 million in taxes every year. Now, with $10 million in annual loan payments, you record a $6 million net loss and pay nothing in taxes. And that is called private equity innovation. Another benefit is that if things go well, the PE firm can extract profits, but if things turn south, your company and its assets are on the hook for the loan. This is often referred to as heads I win, tails you lose. Not to mention that the loan covenants will require you to maintain a minimum earnings ratio, so better get to work. That's the next 2 years of your life. In the meantime, your new PE owners will set their sights on the 2 basic levers they have to work with: increasing revenue or reducing expenses. Now, when you hear increased revenue, you might be thinking you'll actually get to build something. But R&D is the first thing private equity cut after taking control. Increasing revenue looks more like this: price hikes. Your previously happy customer base is understandably ticked off by this move, and some of them jump ship. Now it's time to crack out the private equity toolbox. Here are some of PE's favorite tricks to inflate short-term revenues. It starts with basic things like making everything a subscription or adding hidden fees, which only infuriate your customers more. To offset this, PE might explore cutting supplier costs, eliminating critical services, even if you're a hospital, and retail private equity's favorite way to mortgage your future, the sale-leaseback of all of your properties. These stories have become so common that consumers now preemptively stop buying from companies acquired by private equity. So congratulations, your company has now entered its final stage of existence. Sales started sliding slowly at first and then falling uncontrollably. With profits in freefall, private equity turns their attention back to reducing expenses, which translates to letting go of some of your best talent. It was this brilliant strategy that led to the largest hack in U.S. history. The executive charged by the SEC was hired by the PE owners, who are also well known for their aggressive cost-cutting measures. Which brings up the kicker to all of this. The whole time this is going on, your company is paying millions in management fees to the PE firm and the crony execs they put in place to replace your guys. You've seen this story before, at Toys R Us, at Payless, which went bankrupt twice, and at Sears, where the same fund bought, gutted, bankrupted, and then again bought the liquidated assets of the company. Most companies focus on value creation, but private equity firms specialize in value extraction. A better analogy would be to say that PE sees your company as a juicy fruit begging to be squeezed. And once they've squeezed out every last drop, They sell the scraps or file for bankruptcy. Fortunately, you're getting off this bus in 2 years, and somehow you make it. PE sold your office and fired most of your team, so you're in a co-working space now. Maybe you even managed to hit those earnouts. Either way, it's finally your last day. As you walk out the door for the last time, you might ask yourself, was this all worth it? In total, you spent 37,000 hours working at your company over 10 years. Add up your $12 million payout and about $2 million in salary, and you made $378 per hour pre-tax. Not bad. Except the lawyer who papered the sale agreement makes nearly the same amount. But hey, now's the time to celebrate. You finally got paid, and now you get to watch your life's work get strip mined from the sidelines. Champagne problems, am I right? Now, if you're wondering how you ended up here in the first place, check out our video on being a venture-backed founder. This video is sponsored by bestpitchdeck.com, where you can see thousands of pitch decks that closed multi-million-dollar investments and deals 100% free. Don't forget to hit the subscribe button to learn more uncomfortable truths about business.